Guys, can you hear that sound? That's the beautiful sound of the US Foreclosure Moratorium officially ending on July 31st. That's right, the Federal Housing and Finance Administration just confirmed it. After July 31st, banks will start to be allowed to foreclose on borrowers who haven't been making their mortgage payments. And of course, this is a long time coming. For the last 15 months, banks have been restricted from foreclosing on the roughly 1.7 million borrowers that are in serious delinquency. And this has had massive negative consequences for the housing market in the interim. At a time when home prices are at all-time highs and inventory is at all-time lows, the U.S. government, in its infinite wisdom, decided to make a policy that further restricted inventory from the market and pushed home prices up further, helping existing homeowners gain more wealth and screwing over everyone else who hasn't bought a home yet. And guys, I understand just how frustrating it's been for you in this time period over the last year and a half with escalating home prices, crashing inventory, and the US government making it worse. So what I'm going to do in this video is give you the key data so you can better understand what's going on. The first thing we're going to look at is just how much existing homeowners and those who've had the privilege of already owning their home are benefiting from the current housing bubble and are benefiting from the government's ridiculous policies towards housing. It should make you really mad. The second thing I'm going to do is show you just how messed up the foreclosure moratorium is and just how much damage it did in terms of inventory to the housing market. The third thing I'm going to do is show you, with the moratorium lifting, just how many new homes are going to flood the market over this next 6 to 12 months and what the timing of that's going to be. So this is going to be key data for you guys. You're not going to want to miss this. Let's get into it. The first thing we're looking at here, guys, is cumulative mortgage debt in America in yellow and homeowner equity and wealth in blue. What we can see here in 2021 is that homeowner equity reached a record $23 trillion in 2021, and that's compared to $11 trillion in mortgage debt. So just a real quick, guys, the way to think about this is that if mortgage debt is $11 trillion and homeowner equity is $23 trillion, that means that the total value of the US housing market is 34. So if you subtract the 34 value by the 11 million in debt, you get 23 million in homeowner equity. And that's basically the amount that existing homeowners see on their net worth statement. And this big blue slice means that those existing homeowners are the richest they've ever been in terms of how much wealth they're deriving from their house. We can see that even the level here in 2021 is 50% higher than it was in homeowner equity in 2006. And what bothers me is that I think a lot of people see this graph and they think it's good for America to have so much homeowner wealth. But guys, it is not good. Because what this means is that existing homeowners are extracting more and more wealth from the housing market, while you, the renter who haven't bought in, is getting more and more locked out and more screwed. Guys, it's super important that we just establish this context up front, because US homeowners have never been richer. That's right, they've never been wealthier. And with homeowners so wealthy, the flip side to that coin is that home prices are really high and that all the other renters, the middle class renters especially, are just priced out of the home ownership market. And that's a really unfortunate thing that's going on in society right now. And the US government is squarely to blame for making the problem worse. Because the foreclosure moratorium, while it was kind of a well-intentioned policy at first, has basically deprived the housing market of key inventory that it needs at a time when prices have never been higher and inventory has never been lower. You guys can see what I'm talking about on this graph where we're looking at two lines. The blue line is the number of active foreclosures in America. The yellow line is the number of loans that are over 90 days delinquent. These are called serious delinquency loans, and we can see that throughout history, there's a really strong relationship between these two. When the serious delinquencies go up, the foreclosures follow. When the serious delinquencies go down, the foreclosures go down. And that's because if you're in serious delinquency on your loan and you haven't paid mortgage payments in over 3 months, generally speaking, you're giving back the property at some point, or you're selling the property. You're not going to own the property for much longer. However, guys, this trend is broken down in 2021. We can see here that the amount of people in 90-plus day delinquency is shot up to 1.7 million, while the amount of foreclosures is at a record low of 150,000. And this gap here is basically the foreclosure moratorium in action. If you guys are enjoying the data presented in this video, just please hit that like button. I spend a lot of time putting this content together, and if you hit that like button and get me more exposure on YouTube, I'll be able to put out even more videos. So just do that. I would really appreciate it. Additionally, make sure to leave a comment. I want to hear what your experiences are in the housing market as a buyer or renter, and if you are also frustrated about the government intervention that we're seeing in the housing market over the last 12 months. All right, guys, let's get back to the video. If that foreclosure moratorium didn't take place, we would have seen these foreclosures shoot up along with the increase in delinquencies. But they haven't, and that's essentially created a backlog of about 1.5 million homes that should have been listed for sale on the market in some way, either through direct foreclosure or through the owner putting the home on the market for sale. However, none of that's happening right now due to the foreclosure moratorium. And this is super messed up, because inventory is at record lows right now. We could really use those 1.5 million homes in the housing market for people that are trying to buy. But the government is saying, no, banks, you're not allowed to initiate foreclosure. You're not allowed to force the homeowners to sell. We're going to protect those homeowners. And this is really where it gets kind of devious, because the government's saying we're going to protect the homeowners in default. But guys, let's remember that those homeowners have participated in all of the home price appreciation that we've seen over the last couple of years. So even though they've lost their job, maybe due to COVID, they are still way wealthier than they were 3 years ago due to the home price appreciation. So most likely what would happen is an outright foreclosure. I don't think we're actually going to see a deluge of foreclosures when these moratorium lifts. I think we're actually going to see a lot of these homeowners in default and forbearance just list their home for sale, pay off the mortgage debt, and then probably pocket between $20,000 or $40,000 in cash. That's right. According to data from Black Knight, over 96% of delinquent mortgage borrowers have over 10% of equity in their homes. With an average mortgage balance of about $200,000, that means that over 96% of delinquent borrowers, if they were to sell their home today, would pay off their debt and then put at least $20,000 of cash in their pocket. That's the segment of society that the government is trying to protect here with the foreclosure moratorium. This makes me even more mad when I start thinking about why America is having an inventory shortage right now. A lot of people like to say it's because of huge demand for homes. Well, there is an uptick in demand for homes, but that's actually not the real reason why home prices are going up and inventory is going down. The real reason is actually because there's been a shortage in listings. This is something a lot of people don't talk about, but the amount of new listings on the market over the last 12 months is about 30% lower than it was in the previous year for a variety of reasons. First, it was COVID. Then it was, people being scared to list because they can't find a new home. There's just not enough new homes coming to market right now in America. And you guys can see what I'm talking about on this graph, where we're showing basically the trailing 12-month listings, new home listings coming to market in America. And we can see that, historically this was a pretty stable number between 5.5 and about 6 million new homes coming to market each year in America. But then we can see as soon as COVID hit, this number just started plummeting, right? It plummeted all the way down to, in April, 4.6 million homes listed over the previous 12 months. That's over a 1.3 million decline from the level in April 2019. A 1.3 million decline in the amount of listings. And guys, this is really what's causing the housing crisis. Not so much that demand is crazy, but that existing inventory, existing new listings they're not happening. And fortunately, we've seen a bounce back over the last couple months. And I think we're going to continue to see a bounce back going forward as home prices are really high and homeowners decide to sell. But just think about in your head, think about that 1.5 million foreclosure backlog. What could that have done for the housing market over the last year if those foreclosures were allowed to go through and those homes were allowed to come to market? We might not have ever had this huge issue with super low inventory and super low listings. And this is where it's got to really start to piss you off if you're a renter right now. Because this foreclosure moratorium, seemingly meant to protect the most vulnerable, is protecting people who are richer than they were 3 years ago because of home price appreciation. And that if any of these people sold their home right now, they would pay off their debt and then have more than enough money to pocket probably $20,000 to $40,000 in cash and then go find a rental somewhere. Maybe not the most ideal situation, but you know what? Not the worst outcome. What a much worse outcome is record low levels of new inventory, and then the government enacting a policy which makes those low levels of inventory even worse and exacerbates the housing crisis. But guys, it doesn't stop there. The idiocy and the unintended consequences of this foreclosure moratorium get even more ridiculous when we think about their effect on banks and lending. Just zoom out for a second and think about a bank all of a sudden who has all of these loans that are in default, in serious delinquency. When that happens, a bank needs to reorganize their balance sheet and basically move those loans to like a high risk category where they're going to face potential loss and write-downs. When that happens, the bank needs to keep more cash on hand and take less risk in terms of making new loans. And that's exactly what's happening right now. Banks are the most cautious they've been in terms of making new loans in over 7 years. Their level of cautiousness and the strictness in their underwriting standards right now is at the same level it was in 2013, 2014. And that's actually a very bad thing for the housing market, because it wasn't even like over the last couple of years before COVID that banks got like crazy making loans. They were still at reasonable levels. It just happens now that since COVID, they're extremely cautious, which is making it even harder and harder for families, middle-class renter households to qualify for a loan in this crazy housing market. So you guys can see what I'm talking about on this graph, where we're looking at the Mortgage Credit Availability Index over the last 10 years. And this is an index put together by the Mortgage Bankers Association. And basically, they survey 95 different lenders each month, and they ask them questions about how stringent their mortgage and underwriting standards are. Things like, what are the credit scores you're requiring, the loan to values, the debt to incomes. And the lower this index goes, that means the more strict banks are getting in terms of lending. And we can see here that basically through May 2021, lending standards are at the same level of strictness that they were in 2014. Coming out of the last big housing crash, banks are about as scared to lend now as they were in 2014. This is a direct consequence of the fact that they have so many bad loans on their books right now. And let's be clear about something. This massive decline in mortgage credit availability is not a good thing. Because in the couple of years before COVID, banks were still being pretty stringent. Those levels you saw before COVID were not even close to the levels of aggressiveness that were in the mid to early 2000s. Mid to early 2000s was about 3 times on that index higher than the levels pre-COVID. So the fact that we've seen such a stark decline in that index and an increase in lending strictness going back to 2014 levels, that's accomplishing exactly the opposite of what the government wants right now. The government wants mortgage credit to be more available to households, especially middle-class renter households and minority households. Well, sorry guys, the credit isn't available because you're telling banks basically, hey, you have these bad assets on your books. Sorry, they're going to stay on your books. You're not allowed to get rid of them. You're not allowed to foreclose. You're not allowed to force the mortgage holders to sell. And this is where, this foreclosure moratorium policy just is so ridiculous, right? Because on one hand, it's causing inventory to go down and prices to go up even higher, which sucks. But on the other hand, it's also making it even harder to get a loan. So you're just being like punched from all directions right now if you're a middle-class renter. You're being punched from all directions by the US government. And the really devious thing is that they claim that these policies are to protect people. And that's complete BS. These policies are squarely meant to do one thing, and that's to try to prevent the inevitable housing crash that is going to occur in America over the next year. Because home prices right now are at record levels relative to wages, and in the end, there's nothing the government can do to actually stop this crash from happening. But they can try to prolong it, and they are trying to prolong it. And it's just really unfortunate because it's really causing a lot of harm. I see you guys in the comments talking about like, I'm trying to buy a house, I'm priced out, I can't afford the down payment, I can't qualify for a loan. Well, who do you have to blame? It's the US government. A lot of people actually are trying to blame like BlackRock and Wall Street, guys. I did a video on that a couple weeks ago. Wall Street is not to blame here. They own a very small share of the US housing market. The government, however, specifically the policies enacted by what was originally the Trump administration enacted this policy first, and then it was kept in place by the Biden administration. This is the real problem here. Let me just also say one thing. I think initially the foreclosure moratorium was a good idea when COVID was a raging pandemic. Right? And you probably don't want during a raging pandemic for people to get kicked out of their homes and likely have to move in with relatives or friends. That could increase COVID spread. But I think as soon as the vaccinations started rolling out in December, this mortgage moratorium should have been immediately repealed. And the fact that it's still here in July 2021 is absolutely ridiculous. Now, the moratorium is rolling off on July 31st officially, and banks will start to be allowed to foreclose. However, the Consumer Finance Protection Bureau has added additional stipulations that are going to prevent banks from foreclosing on certain borrowers. So they're just going to kick the can further down the road. It's probably not going to be until early 2022 they're going to see the real deluge of either foreclosures or, more likely, homes being sold by defaulted borrowers coming to market. So what does this mean for you as a potential home buyer or real estate investor right now in mid-2021? When are we going to start to see the softening in the market occur from foreclosures and borrowers who are defaulted listing their homes for sale? So like I said, I think it's going to be more early 2022 when they really start to hit. Probably it's going to be the middle of 2022 when we really start to see big surges in inventory coming from this situation. Now guys, an important thing to remember is that not all areas of America are impacted equally in terms of defaulted loans and potential foreclosures. Certain states have much higher levels of serious delinquency than others. So if you are thinking of moving to a state and buying a home or forming an investment strategy around where there might be foreclosures, you're going to need to understand this data by state. And I'm going to show that to you right now, the states with the highest percentage of defaulted loans versus the lowest. So guys, that's what we're looking at on this map. We're looking by state the percentage of loans that are currently in default, mortgages outstanding in the state. And this is data again from Black Knight. It comes from May 2021 data. And we can see that the states in red have a higher percentage of loans in default, led by Louisiana and Mississippi, way ahead of everyone else. Around 8% of all loans in these states are in default. Other states, predominantly in the southeast and southwest, you can see basically Florida, Georgia, Alabama, Texas, Arkansas, and Oklahoma all have 6% plus rates of default as well. So when this foreclosure thing does come down the pike over the next 6 to 12 months, we're going to see it more in these states. Some other states where this is more likely to happen include Nevada, West Virginia, Maryland, and New York, which are all around 6.2 to 6.5% foreclosure rate. So you see this map and you see over 6%, that's a higher level. The states in blue, on the other hand, have a much lower level of foreclosures. Potentially, we're talking a lot of mountain states like Colorado, Utah, Idaho, and Montana. Surprisingly, actually, like Oregon and California also have pretty low rates of defaults given how high the job losses are there, but I guess those job losses are really concentrated among renters and not owners. So guys, again, if you're moving to a new state and want to understand the foreclosure situation or forming an investment strategy around this data is going to be key to do that. Now, to be clear, the states with the highest foreclosures I don't think necessarily are going to be the ones with the biggest overall price declines. When we go and actually look at the last housing crash, it wasn't necessarily the cities with the most subprime loans that had the biggest declines. In some cases that was true, but there was other situations where cities had very low levels of subprime loans and foreclosures, but huge losses in value and vice versa. So the other thing to consider is, of course, the ratio of home prices to wages and rents in the local state and economy you're buying. That's another thing that you're going to look at. If you like this content, also make sure to subscribe. I come out with 2 to 3 videos per week on real estate related content. I come out with market deep dives to specific cities each Wednesday and more general videos on the weekends. Make sure to subscribe. Check out my video history. I have a lot of great content there. Until next time, guys, this is Nick from ReVenture Consulting signing off.